Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs, and today we're going to be covering the topic of Target Maturity Bond ETFs. You might not be aware, but here at BMO ETFs, we are Canada's largest fixed income ETF provider. And recently, just a couple months ago, we launched our new Target Maturity solutions with 3 different maturity dates and tickers to choose from. So we're going to get into this 101 in terms of how these products work and really what makes them different relative to investing in traditional bonds. Before we get started, a quick reminder that we are not providing investment advice or recommendations. Today is all about information and education. And joining me today is Matt Montemurro, Managing Director and Head of Fixed Income and Equity ETFs here at BMO ETFs. Matt and I have worked together for over 15 years, or close to 15 years now. And his ETF experience as a portfolio manager and overall industry knowledge makes him a great guest for today. So thank you for joining me, Matt.
Thanks for having me, Erin. Looking forward to our discussion.
Let's get into this and maybe start simple. Can you explain to us what is a Target Maturity Bond ETF and really what are some of the differences or similarities between how an investor might typically go about their fixed income exposure?
Yeah, so Target Maturity Bond ETF is exactly what it sounds like. It's a bond ETF that matures on a specific day, just like a bond would. The ETF owns a diversified basket of bonds that mature within a defined maturity year. So let's call it 2027, 2028, 2029. All bonds in the portfolio will mature in that specific year. Once the final bond matures, the ETF itself will mature. And what happens and what that means in practice is that the ETF unit holders will receive their capital back upon maturity date. The portfolio itself is actually no different than any other plain vanilla bond ETF. They both provide exposure to a diversified basket of bonds based on a predefined strategy, trade on the exchange, bringing the benefits of tradability, transparency, cost effectiveness, and efficiency to bond investors. The main difference here within these strategies, though, is the traditional bond ETFs, they do not mature. They continue to exist with the risk characteristics that are representative of the underlying universe, underlying index. So as a bond no longer meets those criteria, let's say they're under 1 year to maturity, that bond is often then sold in the market and then reinvested in another bond. Because of this, the duration of the bond fund, the bond ETF, tends to be relatively static and aligned to what that representative of that underlying universe. In a target maturity ETF, the bonds are not sold. They are held all the way to maturity. The interest rate sensitivity or your duration risk over time is going to decrease as you move closer and closer to that maturity date. The duration impact is the main difference here between owning a target maturity ETF and a traditional bond ETF. Target maturity, again, reduces over time to that maturity date, where the traditional bond ETF will remain relatively static over time. That's the main difference in a nutshell.
Awesome. And I'm going to put a slide up here that shows the 3 options that we have available, but maybe just touch a bit more around what bonds are actually included in these products. Are they government, corporate? What's the credit quality look like?
So for BMO's suite, we are 100% Canadian investment grade corporate. So credit quality is BBB and above. We try to cap our BBB exposure to make sure it is a very high quality portfolio. If you look at the names in the portfolio, these are blue chip issuers. You will have heard these. These are staples in the Canadian industry. It's the Canadian banks. It's the telcos. These are names that and they're Canadian corporate bonds, giving you that little bit of extra yield that you might want from the fixed income portfolio, but the safety around the quality names that
Okay, and you talked about sort of the duration difference between if you were to go about doing something like this, but I want to get into a little bit more about the benefits in terms of a target maturity ETF relative to going out and building your own individual bond ladder? Let's run through those.
Yeah, so many investors will use actually target maturity ETFs to build out their own traditional fixed income bond ladder. Like let's call it a bond ladder 2.0. But several factors I think have moved investors away from individual bonds and toward individual bonds and individual bond ladders and toward the ETF or the target maturity solution. So one being diversification. ETFs diversify away idiosyncratic risk. They provide exposure across sectors, across issuers, all within a single trade. Long term diversification is key to risk management and risk mitigation. So, that's a huge benefit of using the ETF structure versus your own bond ladder at home. Cost. Our suite of BMO ETFs, so the target maturity, they cost 15 basis points for exposure to a diversified basket of bonds. Retail bond spreads, if you look at it, if you're trying to buy the bonds yourself for corporate bonds specifically, they range from 100 to 200 basis points. That's 1 to 2% on a yield to maturity of what, 3 to 4? That's 50% of your return in some cases is eaten up by just execution alone. So another factor, my team continues to work with the best institutional bond desks in the industry. We pass those benefits from liquidity benefits, from pricing benefits, from spreads, the institutional access to bonds, we push those through to the retail investors. So using the ETF, you are getting the same access that institutions, pension plans, asset managers are getting in the market. And finally, liquidity. I think the bond market is an OTC market. It makes it significantly less liquid and more challenging for the average investor to participate in. There's no exchange here for traditional bonds. So it is very difficult for you to build out that bond portfolio over time. And then secondary, to build out that bond portfolio, let's say you have a little bit more money you want to invest, to find that same bond over and over again to continue that ladder is extremely difficult, time consuming, resource constraining. The ETF, it does it for you. It allows you, it brings bonds to the lit market and allows you to trade on the exchange. So really it solves a lot of problems that traditional bonds plagued investors with for a long time. The ETF and these target maturity bond solutions solve those problems in many ways.
I know we've talked a lot on the channel about just the innovation of fixed income ETFs in general, and this carries a lot of those same benefits, just takes it a step further, which is awesome. Let's talk a little bit more about the maturity feature. What happens at the end of the day when these ETFs reach their maturity date?
Yeah, very simply, upon the final underlying bond maturity, the portfolio will then be 100% in cash or cash-like securities, and then will just get redistributed to investors. So on our website, if you look up the tickers ZXCO, ZXCP, ZXCQ, all three of those will state a specific date on or around where you will see that expected maturity date. They're all in November of the specific year, 2027, 2028, 2029. So when you go out on our website and you want to buy that ETF, you will know you will get your money back in and around those specific maturity dates. So you'll be able to either A, use it for planned expenses, B, reinvest it in the market. So quite literally, that's the date you get your money back, and then you could redeploy as you wish.
Very, very reliable and very much like holding an individual bond in that way. Talk to us a bit more about how we can use target maturity ETFs to manage things like upcoming expenses, retirement income, any short-term goals, that type of thing.
Yeah, so this most common use case, aligning your upcoming expenditures, cash needs within the maturity year of a target maturity ETF, that'll enable you to both maximize your return while reducing your risk over time and get the cash when you need it most. So one of the challenges and concerns that some investors have of just straight investing in the market is what happens if during that period when I need the cash, my account is down or my bond portfolio has lost 2%. And now I needed this cash need. I needed the $100 and now I only had 98. And I think that's a concern for a lot of investors. Well, for a target maturity bond ETF, because you are holding those bonds to maturity, you don't have to worry about that. You will get the money back when you need it. And I think a lot of investors, whether it's saving for education, whether it's upcoming house payments, whether it's retirement income, the target maturity ETFs are perfectly designed to provide investors that capital back when they need it and want it most. So, if you look at our product suite, it does provide you that flexibility. So, for education, you don't have to have one single product. You could spread it over the years of 2027, 2028, 2029 to align to basically, years of tuition that you're going to be paying. So very, very flexible tools, allows you to take it out early if you need to, unlike a GIC, but allows you to also get that certainty that, hey, I'm not going to be negative because if I'm holding this bond, I'm buying it today and I'm holding it to maturity, your expected return, is relatively locked in with that yield to maturity.
Okay, let's talk about risks. Are there any risks or considerations people should think about when using these ETFs?
Yeah, so I think the risks are very similar for a lot of bond ETFs or fixed income investments. So, you're looking at credit risk, so the exposure to corporate bonds, interest rate sensitivity. Although it is mitigated a bit in the target maturity structure, you do have sensitivity to moving rates. Default risk, again, that's why we want to populate the portfolio of high quality blue chip issuers to avoid that default risk. Liquidity risk. This is a more of a bond specific problem where my job is to make sure that liquidity risk is not found in the ETF. So these are all inherent risks that are in every fixed income investment, not necessarily specific to target maturities. As you move to the target maturity specific, I want to talk about kind of overall most target maturity ETFs. So reinvestment risk is a risk that a lot of investors face. So, for example, most target maturity ETFs will take the proceeds of a single maturity in that final year, let's call it 2027, and then they'll reinvest it in money market for the final year. So, for example, in an environment where rates are coming down, like today, the reinvestment rate in 2027 will likely be lower than what investors are earning in the portfolio today. And the challenge with that reinvestment risk, is that could lead to material differences between what an investor expected to return based on their yield to maturity and versus what they actually returned. The final risk, I would say, is portfolio changes, rebalancing. Most target maturity ETFs will rebalance several times a year. What this does is expose investors to changes in the composition of the portfolio over time, and it changes that overall risk. So you're not necessarily getting those same blue chip issuers over the extent of the entire or the maturity of the entire holding period of the ETF. So at BMO, what we wanted to do when we launched our product suite is we wanted to solve these problems. We specifically spoke to investors and said, hey, what's the biggest challenges that you have with the current iteration of target maturity ETFs on the market? And we wanted to create a solution that provided a superior investor experience addressing many of these challenges. So what we really tried to do is we wanted to bring the benefits of a bond with the benefits of an ETF, all while providing an investor with a truly bond-like experience. And so our suite, to start, we use a static portfolio of bonds. So investors know when they invest, they will have the same exposure on day one than they will have at the end on that maturity date. Those blue chip names, if we purchase a Bell Canada bond on day one or a Bank of Montreal bond on day two, those weights do not change. Your blue chip, high quality credit exposure, it gives you the same access and same exposure over time. Finally, secondly, we use a derivative within the portfolio to reduce reinvestment risk. At the launch of these portfolios, we enter into a derivative and it locks in a reinvestment risk for the final year. Investors will know on a daily basis, if you buy the ETF today, this is the expected return at maturity. So in general, for a bond, the yield to maturity on most bonds will give you the expected return over a holding period if you hold it to maturity. The challenge with that metric in most target maturity ETFs is that is showing your return to that maturity of the bond. But then in that final year, we said you have to reinvest in money market. So there's uncertainty from that maturity to when the ETF matures. So what we've done by implementing this derivative is that we've provided an expected return of not just the bonds, but of the actual ETF. So we will give you an idea of what you will earn um, on when you buy it today as the ETF matures in 2027, 2028. And this is a key and material difference. And again, it's solving that uncertainty for investors. So if you look on the website and you look at up ZXCO, ZXCP, ZXCQ, those are going to provide a much more bond-like exposure, a superior investor experience for those who truly want to maximize the benefits of owning bonds within an ETF wrapper. And I think it's going to be a true experience, or truer experience for someone who is really looking to maximize savings and use that cash or use that income at a later date that they've defined.
I love that we've taken an innovation and listened to investors in terms of the challenges with that and just further made these solutions even better in the marketplace. So it's awesome. Let's talk about how these ETFs can fit in an overall portfolio strategy on the fixed income side of your book when it comes to things like traditional fixed income ETFs or GICs. Are there strategies we can look at there?
Yeah, like I look at them and I say term maturity bond ETFs can be very complementary to traditional bond portfolios. And I think they can actually often, they are looked at as a more flexible replacement to kind of GIC exposures. So I see that they fit in both ways there. Since these ETFs mature, you know, investors can remain invested in the core of their long-term allocation without having to, sell for specific needs. Again, education, specific life events, any sort of income needs. So you can keep yourself invested. You don't have to succumb to market timing by having your core investment, let's say in our aggregate bond portfolio in ZAG. That's your long-term fixed income solution. But having a sleeve in one of these target maturity to align with expenses in 2027, 2028, 2029, that allows you to keep ZAG untouched, keep that long term for your long term allocation, and this is more your shorter term, cash needs solution. So I think those are the target maturity ETFs are very complementary to a traditional bond portfolio or bond ETF. I do look at it and say, if you compare it to a GIC, you're getting a very similar return experience with a GIC, but you just have that added flexibility that if you did need to sell early, you needed that cash early. In a GIC, you have to break and forego all of the benefits you had. In a target maturity ETF, you have the ability to sell it at any point and be able to take any of the earnings that you've had or any of the return that you've had. So I think that flexibility does also help because you don't know what's to come, what's the futures. You can plan, for 2027, but if you need that cash earlier, the flexibility of a target maturity ETF is kind of the best of both worlds in that case.
For sure. What should investors expect from like a return and price perspective? How are these ETFs priced as they approach maturity?
Yeah, so ETF's risk and return will be based ultimately on the underlying portfolio of bonds. So, as such, as bonds move closer to maturity, their price is going to migrate toward par. So it's either going to move up if the bonds are priced at a discount, so below 100, so they're going to move up toward 100, or if the bond is trading at a premium, so above 100, you're going to see some price coming down over time. But in terms of return expectation for individual bonds, you look at yield to maturity. So, if you look at the yield to maturity, the weighted average yield to maturity across, that should be what your expected return will be. But for our BMO suite, what we do is we've added another measure called the internal rate of return, the IRR. And what that does is because we've added the derivative with that locked in final year, we can tell you if you buy the ETF today, you'll be able to earn this if you hold the ETF to the ETF's maturity date. And that's what's unique. So from a price perspective, it really depends on how bonds are trading. Right now, in an environment where bond yields are coming down, bonds are generally trading at a small discount and or a small premium. So you're going to see some bond moves over time, but what you are going to earn is that coupon from a yield to maturity perspective, and that's the benefit of bonds. So you're going to have this expected return. We put all of these metrics on our website on a weekly basis. You'll be able to identify if I purchase today, here is my expected return at the end of the ETF's life.
Awesome. Thank you so much, Matt. That was great insights on this new solution. Thanks to our viewers for tuning in. If you want more information on these, you can go to bmoetfs.com. I'd also encourage you to share this episode with your family members, your friends, colleagues who might find this topic interesting. Thanks again for joining us, and we'll see you next time. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.